picture further than highlighting. It's not going to work at all. Oh, thank you. Didn't realize I was muted. Goodness gracious. I'm doing all kind of talking. Hello, everyone. Good to see you all. Hope you had a good day. I was saying that we are going to talk about due diligence tonight. And so excited to chat with Brian. Brian Bellet is going to join us here in a moment. If you guys remember, several years ago, he came and talked to us about due diligence and the process upon which we should be investigating the businesses that we think about adding into our portfolios. So we're going to talk to Brian this evening, and then we're going to, and I really want you guys to think about last week's session where we talked about valuation, this week's session where we talk about due diligence, and really put the two together so that we can be more informed and make strategic decisions when we're adding companies into our portfolio, right? Some of it's gut instinct, but most of it shouldn't be. And so we want to balance that with the actual questions we should be asking and the logic we should be using. So Brian will come and talk to us here in a few minutes, and we'll go for about 45 minutes today. I do have a meeting at 7 that I've got to get downstairs to, 7 Eastern. So we'll let Brian kind of go over his information, probably about 40, 50 minutes or so. Thank you, Sharnetta, for telling me that we were muted in the beginning. I may have to edit out those first few minutes because otherwise it's just going to be silly. Good evening, good evening. I'm so close to the camera. At a different position planned, and then the glare from outside is just still too bright outside. I think this light over here is going to give me a problem. Let me go change this light. Okay, that's better. Got rid of that glare from that light back there. Hi, T-Shine, how are you?
Hey, can you hear me?
You sound low.
Yeah, okay. I don't know what's going on. Can you hear me now better?
Yes, much better now.
Okay.
Much better.
I'm prepping for a severe thunderstorm, so if I go, I'll try to get back on.
Oh my, it's bad weather everywhere.
It's just summer weather, you know, that we're in the high 90s and just doing this stuff.
Yeah, see, it's cool here where I am today. So it's really cool. It's not warm at all. I got off the plane and I was like, oh, this is nice.
That's usually, I mean, Columbus usually has nice weather. I mean, it's.
Yeah, it feels like it's only in this, I don't even know what the temperature is, but it feels like it's in like the maybe high 60s maybe.
Oh, hi, sir. How are you?
Hi, Brian.
Hey, how is everyone?
Good to see you again, sir.
Likewise, it's been a while. Not too long, I guess.
Well, we are always excited when you come visit us. You have
well, thank you.
Such a wealth of knowledge that we're and so gracious with your time. So for those of you who have been around for a long time, Brian Bellet is a master investor, right? He's probably well over 200 at this point. I think you were approaching 200 when you came to see us a couple of years ago. And so I'll let him talk about that. But Brian does amazing education on investing and crowdfunding. He'll tell us now about his company being acquired, and now he's a part of King's Crowd, which is a great organization that I love, the aggregation of information and data that they have about founders. But Brian was the perfect person to come and give us a refresher on how to do your due diligence. As all of you know, every week we bring a new founder to the community to consider adding to our portfolios. And I want you all to be armed with the strategic way to properly do due diligence, right? Investing should not be about guesses and hunches. While that might be a small part of it, that can't be the foundation of it, right? And so, Brian, thank you so very much for joining us and walking us through this process. We really appreciate you. And I wouldn't have anyone else come talk to us about this because I respect the knowledge and the experience that you have in this area. So thank you.
Thank you. That's very kind words. I think you set the bar really high. I'm not as impressive as they're making me sound, I don't think. But I think that's the exciting thing about this industry is, I'm consider myself an average person. I have a day job that is now part of this. I used to do something else, but it allows anyone to invest in these companies. And so that was one of the things for me getting started in my journey is how do you know how to look into these? Like, how do you know where to start and what the resources are? So I'm happy to talk about that tonight. So if it works, do you want to jump right into it? And I did prepare some slides if that works. So I figured we could do about 30 minutes, but feel free again, anyone to interrupt me if there's any questions along the way and can leave some time for Q&A at the end as well. So
wonderful. Perfect.
Excellent. Let me share my screen. Let me know if you can see that.
Yes,
Yes,
sir.
Excellent. So thank you again for having me tonight. So as introduced, my name is Brian Belay, and I am up to, I think, 220 investments now. Don't be intimidated by that, right? It did not happen overnight, and I've been doing this for probably 5 or 6 years now. Also, I'm writing small checks, right? A lot of these investment crowdfunding deals, you can invest anywhere from 100, 500, a couple $100 here and there. So I've built up this portfolio over time. We can talk a little bit about diversification and why that's obviously important, given that a lot of these companies are so early. A lot of them, are going to give it their best shot, but unfortunately might not make it. And so that's why it is very important to diversify and take your time, right? I think especially for someone getting started, it's very exciting to just want to jump in, and every founder that probably comes and pitches you, right? They have such an amazing story and it makes it sound like it's the best thing in the world, which a lot of them are, really great ideas, but you need to be measured. You need to kind of come at this with an even approach. And so I'll talk to you a little bit about tonight in terms of my own due diligence approach. So King's Crowd, just at a real high level, we do this for basically our jobs, right? So there are over 450 active deals online right now that you can invest in across 90 different platforms. So one of the issues that a lot of investors have is, how do you look across all these different platforms? How do you find the different opportunities? And so at King's Crowd, we help aggregate all of those into one place. So we go out to each of those 90 different platforms, bring them onto our platform, make them searchable, make them filterable so that investors can come. And a lot of our tools are completely free. So if you want to come, you want to search, you want to look at the data, you want to read articles, all completely free. In addition to that, we actually do ratings and research also. So we do our own due diligence that, again, my approach tonight is really going to be my own, Brian Belay, individual personal investor here. But as King's Crowd, we also have a complete system, a team of investment analysts that look at the different deals, that provide ratings on them. So as you can see here, it's kind of similar if anyone's familiar with like a Morningstar, that rates different stocks in the public markets and ETFs. We do that for the private markets. So we rate all these deals and we write reports on some of them. So we'll do kind of an analyst report where we do a deeper dive due diligence. And so as an example, right, King's Crowd is one of many different resources out there to help you with your diligence. But going back to, if you just want the raw data, you can come, this is our company filtering search table. We allow you to look and search and sort and filter among all the different deals for a whole bunch of different sort filters. So you can see you can sort by platform, valuation. We collect info on founders. Are they minority founders, women founders? Is it a social impact company? So this makes it really easy as an investor if you want to go and try and narrow it down and say, okay, of the universe of 400 or 500 deals out there right now, what are the maybe 10 or 15 that is manageable for me to look at in due diligence? So that's where, you can use this to help you get started.
And Brian, I share with the
please.
community, I used to go to, when there was 80 platforms, I used to go to all 80 platforms once a week and look for Black founders. And now I only go to King's Crowd. So thank you guys very much for making that job a lot easier because
Oh,
it was
thank you.
a
That's
lot
fantastic to
of
hear. I did the
time.
same. Yeah. Starting out, I can remember when there was maybe, 4 new deals a week in like 2017, 2018. It was possible to keep up with it by going to the platforms, but there's so many now. There's dozens of deals a week, and then each platform may present them differently. And so, yeah, we try and bring all that into one place to make it a little bit easier. So what I'm going to be talking about tonight in terms of due diligence is I took a presentation I've given. Now, due diligence is a huge topic. This could probably go hours. I'm not going to bore you. I'm not going to, hold everyone up from dinner or other commitments or whatever you have going on. But I'm going to give a brief overview of what is due diligence, why it's important, how much time you might want to spend, and look at a couple different things, and then start talking about the actual resources. So for due diligence, what funding portals and broker dealers actually do. What are some potential red or yellow flags to look out for? Some different online resources, not just King's Crowd, but some other tools that I use as part of my diligence process. I'll share, I do have a quick link too to a free due diligence checklist. That's kind of, again, this is just Brian's, questions that I use. So we'll go through all that. So what is due diligence, right? I'm sure probably a lot of people here have either been to a used car dealership, maybe a new car dealership, right? Or bought a house, or even just gone to look at a house for rent. You see something that is offered, right? And you need to go and kick the tires, so to speak, to make sure that what it is that you're getting, that you're going to exchange money for, whether it's a car, a house, an apartment, is actually what you expect, right? You need to make sure that not only are there no underlying issues, right? You could think of like bad things in terms of a bad roof or something for a house, or, having engine trouble with a car. But from a company perspective, right? Are there things that are, under the hood that could potentially lead to issues later on of that company going out of business? So what due diligence really is at its core is just making sure that you're getting at least what you're paying for, and hopefully more. Now, one thing I kind of liken it to, right, is trying to like avoid the minefield. So you can picture there's kind of all these unknown risks. You want to at least make sure that you're giving yourself a good chance to get off that starting line. Now, that is to say, right, these are early stage risky companies. A lot of them are still, unfortunately, going to go out of business. That's part of the game. You can't avoid that completely, but you want to make sure that it's not something that is obviously has red flags or something else from the start, which is what we'll be talking to. So one of the definitions I like of due diligence is basically kind of 3 parts to it. It's the primary objective of due diligence is to 1, mitigate investment risk, by 2, gaining an understanding of a company and its business, and then 3, and this is really important and something I think a lot of people overlook, looking at the suitability of the investment for the portfolio. So that's basically saying, does it align with your objectives as an individual investor? So again, if we take those 3, mitigating investment risk, making sure that it's obviously not fraud. How do you know if the founders are being honest? Did they do all their paperwork? What are the biggest obstacles that they're going to face, in terms of a company? And do they have the right skill set, experience, and team to be able to execute on that? Number 2 is making sure you're getting an understanding of like what this company is. How does this business make money? So this is, again, how do they make money? What's the potential market for this? What is the traction and growth? What does it look like if they have had revenues or paying customers? Or if not, what have they done to date? Have they been able to kind of build a product and get some of that initial understanding and initial traction within their market? Also looking at what's the competition, the competitive market, is it defensible? These are all questions that should be going through your mind as you're assessing an opportunity. And then that third part, right, is making sure that it's actually suitable for you as an investor. Every investor out there has different objectives, right? You might want to invest in something for the super long run. You don't need money for, and again, a lot of these need to be longer term investments because they are liquid, but your goals may differ from someone else's in terms of the types of businesses you want to back or what your expectations of returns are. So this is just making sure that as you look at a deal, once you've kind of decided like, okay, this is the right team, okay, I have a good idea of the business, now you just say, is it the right valuation? Are these the right deal terms for me? Maybe you want to invest in debt or kind of getting some interest, which we'll talk about a little bit later, and then how that differs from a safe or an equity or convertible note investment. So these are all questions that you need to kind of go into upfront to make sure that you're getting into an investment that is aligned with your portfolio. So this is just some quick stats of a bunch of reasons why most startups fail. This was taken from CB Insights. So you can see everything here from there was no market need, they ran out of cash, not the right team, pricing issues, poor marketing. You can kind of go down the list. Now, numbers here add up to more than 100% because a lot of businesses will tend to cite more than one of these as their main reason for going out of business. But if there's a common theme here, and this is a belief that I have and that a lot of other people share, it's that the number one reason that a startup really fails in the end tends to be that a founder gives up, right? Any one of these things on this list that you see here on the left could be a reason that was outside of their control. But a lot of the times, if you're backing a team that is really passionate about what they're doing, that is in it for the right reasons, they're going to find ways around a lot of these obstacles, right? None of these things are outside of the ordinary for anyone who's kind of involved in a startup. Lots of ups and downs with running a startup. And so there's going to be lots of obstacles that need to be overcome. So the real thing that I look at, and we're going to be talking about tonight, and I know some other people believe as well, but it often comes down to the team as one of the most important things, especially when you're in these earlier stage companies. Now, team is one of the areas of due diligence, but you could think of many, many, many different areas. So for example, you could do due diligence on the business, so the team, but not only that, the market, the product, the customers, suppliers, their financials, how much debt do they have? You can look at the technical side of things if it's a technical company. So what's their tech solution, their product roadmap, even things like cybersecurity. You could also think about legal and regulatory due diligence. So this is things like compliance, SEC filings, intellectual property, IP, employment contracts, different things around taxes and legal entity. And then the investment itself, doing due diligence in the deal terms. So that's, again, that portfolio alignment, the valuation, the cap table, market comps, which means basically looking at companies that are kind of similar to them and what they've been fetching in the market. Now, again, this is just the tip of the iceberg in terms of due diligence. We're not going to be covering all this tonight, but this is to give you an idea that, the amount of due diligence that you're going to do is going to depend somewhat on the size of the check you're writing, right? So if we were a huge private equity firm writing really large checks, in the multi-millions of dollars sometimes, they're going to be diving so deep into each one of these things, they might have a full team to be able to do all that due diligence. As an individual investor, in crowdfunding deals online, you're maybe writing, again, $100, $500, $1,000 checks. You're not going to have a full team. You're not going to be able to dig into each one of these areas. So what we'll be talking about are some different strategies to be able to get leverage on your time using some of the different resources that are out there, and then also have an understanding of what, if any of these different areas, for example, do the funding portals, the platforms themselves perform. This is something I'm not going to spend a lot of time on, but I just want to show this chart because it shows kind of an interesting takeaway. So this was a study done for angel investors that were investing in early stage deals. And it was done in terms of looking at 538 different angels across 3,000 investments. Now, the median time was 20 hours that they spent on due diligence, okay? So you can think of that as half of these investors spent less than that and half of them spent more. The interesting thing, and perhaps, it's not rocket science of this outcome, but those who spent less time on due diligence tended to have lower returns. Shocking, right? As you can see, so the red bar here is those companies, those angels who spent less than 20 hours of due diligence. You can see that many more of them failed. They had an outcome that was less than 1x. Whereas if you look at the blue bars here, those are for the angels who spent more than 20 hours of due diligence. They not only had many fewer failures, but if you get to the big side of the returns, they had many more 30x returns, 10x to 30x returns, and 5x to 10x. So the takeaway of this, again, is nothing shocking, right? It's if you spend more time on due diligence, you tend to get better outcomes. However, the big takeaway for crowdfunding investors is, right, many of us, if we're looking at a couple deals a week, we're not going to be able to spend 20 hours. We have different day jobs going on and, plenty of other commitments, and it might not be worth spending 20 hours for a $100 or $500 investment. So unless you really enjoy the screening process, and don't get me wrong, I definitely do myself, and sometimes I may spend that much time, but in general, typically, right, if you're trying to do this, spending 20 hours of due diligence per deal doesn't make sense. It's not worth your time. So the question for, all of us as crowdfunding investors is, assuming that regulation crowdfunding, investment crowdfunding are writing some of these smaller checks, but we can't afford to spend that much time, how can we optimize our due diligence, right? How do we get leverage? One of the great ways, of course, is like joining communities like this. So you can share ideas and do some of this due diligence as a group with other like-minded investors. In addition, the platforms themselves. So when we talk about the platforms, these are, again, the 90 plus different funding portals or broker dealers, they're called, where you go to actually invest in the deals. So this is like the, WeFunder, Republic, Start Engine, Dealmaker, if you've heard of any of those names before. Now, under law, per regulation crowdfunding, the funding portals are required to do a certain amount of due diligence. So it's important to understand as an investor, what is the due diligence that they are doing? So all of these Reg CF, they're called intermediaries, crowdfunding intermediaries, they have to do background checks. So basically for anyone who's an officer, director, 20% equity holder, they are required as the platform that's listing that offering to do background checks. So that at least takes some of that background check, the legal check off of your plate that, typically might come up in a due diligence checklist. In addition, they have to do bad actor checks on issuers as well as participants. So there's certain types of people like marketers and promoters who might be kind of helping to market that offering. They have to do bad actor checks. Bad actor is essentially making sure that this isn't someone who's been convicted of fraud or had been barred by the SEC or other regulators in the past, and that they are able to do this offering. In addition, and again, I'm not a super expert on securities law and everything else, but what they are required to do is anti-fraud and anti-manipulation provisions. So this is just some more checks to understand that the platforms are playing a role to kind of do a pre-screen to at least make sure that nothing being offered is blatantly fraudulent that's being put out there. And fourth, they say that they have to have a reasonable basis to believe the issuer complies with Reg CF and also has an established means to keep accurate records. What that essentially means, right, is once you invest in them as a couple hundred investors, how are they going to keep track of their cap table? Are they going to be doing their ongoing reporting requirements and staying compliant? All of that kind of comes into it. So at a high level, right, you can think of within your mind that these boxes are being checked by the funding portals. Now, this is not to say that someone who is really nefarious or sly might somehow get through and trick the funding platforms themselves. But at some point, you've got to, come to ease with the fact that there's always going to be people out there, unfortunately, right, who are trying to game the system. But for the most part, most of these things should be taken care of by the platforms so that when it comes to your role in actually looking at the companies and doing due diligence, you can focus more on the business opportunity and the team rather than having to think, are these people compliant in all the other ways like they're mentioned here? I'll leave that off the table for now. We can just skip ahead. So what are some resources? As crowdfunding investors, investment crowdfunding, it's amazing that we can sit anywhere. Many of us perhaps work remote. You could be at a coffee shop. You could be at home, on your couch. But we can do due diligence now from almost anywhere. And so some of the great resources that are available are first those funding platforms. This is essentially a go-to. You have to go to a funding platform and create an account to make an investment in any of these companies. And so on that page, you're going to find all of the required campaign materials. That's like the SEC disclosures, the deal terms. You'll also find other investor Q&A. This is, I think, one of the most helpful things for me personally when I'm taking a look at a deal. This tends to be towards the bottom of the page, but when you go to a campaign page, you can see questions that other investors are asking the founders, and the founders and the team are responding to those questions in turn. This is a fantastic resource because you may have people who are, all different backgrounds, from doctors to teachers to anything, attorneys and anything in between, asking questions from their different perspectives and backgrounds. And a lot of times this is like a crowdsourced due diligence in process, right? So make sure you read that Q&A because you can get a lot of really good nuggets in terms of the company and their responses, but also feeling out, who is this founder as a person? We don't have the opportunity, right, to meet one-on-one with the founder a lot of these times in these deals because they're happening online. So being able to see how do they respond to the tougher questions? Are they kind of iffy and like avoiding the question? Are they being rude, or are they like really thorough and really welcoming, the hard questions? These are all really good things that you can actually pick up through that Q&A interaction. In addition, another place, you really need to go to, and I understand, a lot of it's legalese and it's hard to read through, but it's the SEC filings themselves. Now, this is something also that at Kingscrowd, we take all of these filings and we ingest all that data and we kind of present it in a little bit of more presentable, readable way as well. So however you digest the information, it's very important to get the SEC filings because that's where they're going to have all their risk disclosures, the official deal terms, if there's anything to be aware of in terms of like related party transactions and, you know, everything in between. But before you invest in anything, right, you need to understand what you're investing in. And so especially like the subscription agreement, which is usually the kind of electronic form that you sign before you become an investor in a company. Do you understand all the deal terms in that of when it converts and, you know, some of the other things we'll be talking about of your deal terms? Of course, there's ratings and research services. So like Kingscrowd, there's also a lot of great investment newsletters and communities out there. So, you know, feel free to leverage the crowd, to join communities, to interact with others of like-minded investors who are kind of aggregating online. CrowdCheck is also a great resource, more for the founders and for the platforms. They do have a little bit for individual investors as well. But CrowdCheck was, you know, founded by one of the OGs of the industry, Sarah Hanks, and she is fantastic. And their team is super knowledgeable just in terms of the nitty-gritty nuances of the regulations. So if you ever have questions, you know, definitely highly recommend checking out CrowdCheck. And then also use whatever this app or the product or the service is. If it's a local business that's near you that you're considering investing in, go and check it out, right? This is one of the best ways to do due diligence, where you can see, is it aligned with how this founder is portraying this? And, you know, is it actually a delightable, you know, good thing to use? Do you enjoy it? Is it intuitive? These are all things you can really find out pretty quickly. And that's another great source of feedback while doing diligence. Also media, there's different media resources out there. So there's a whole bunch of different podcasts and different shows that are put on, some by the funding platforms, some not associated with them. So there's Inside Startup Investing, which is we interview at Kingscrowd. We'll do interviews and podcasts with the founders, and then we'll publish those. So you can check that out. But even entertaining shows, honestly, what like Shark Tank or The Pitch. I love that show. It's a podcast. Meet the Drapers, Adventure Capital is, I believe, WeFunders podcast. A lot of resources out there. And, you know, what these are super helpful for is starting to learn from other investors the types of questions that they're asking different companies. So sometimes they may actually be interviewing a company that you're interested in, which can be very helpful. But also just from an entertainment perspective, it can be fun to listen to, and then also an educational and a learning resource to be able to help you understand, like, what are the types of things for this type of business that investors would be looking for to make your diligence better. And then, of course, doing online research. So there's different sites like Crunchbase, Statista. Sometimes these are free resources. Google, obviously another really big one, LinkedIn. So when you're doing due diligence on the team, on the founders themselves, go to LinkedIn, look at what their past experience is. Have they published articles on LinkedIn or other places? You know, read that because you can learn a lot about the team through those different platforms and pages. And then website and social media accounts, right? So if this is a more consumer-focused company, take a look at how active their social media is, how big their following is, those types of resources. There's just a sample chart, you know, if you're looking at market sizing or something on Statista, an example of what you might get showing growth rate over time. Again, I'll do a shout out for Kingscrowd. And again, I'm biased here, right? Because I am at Kingscrowd as an employee, but we take all that info from market sizing, market growth rates, and we provide all of that for every single deal on each page to make it a little bit easier to kind of bring your diligence into one place. In addition, a new feature we actually just launched that is super exciting are kind of like a red flag, yellow flag. We call them deal considerations, which are like, what are the key challenges and key risks for each raise? So for example, and these are things that even if you don't use Kingscrowd, some things to look out for in terms of red flags. So uncapped safes. A capped safe means that there's a valuation cap. So for example, you might see a $10 million valuation cap on a safe or a convertible note, which means that at the next financing round, when it converts, it would convert at 10 million. Sometimes there's uncapped safes, which means there's no valuation cap. Now, there may be very few reasons when this would be, you know, something that could be expected, but in general, that means that you're just going to get the same valuation as whatever the next round investor is whenever they come in. That could be a year or 2 years later. So essentially, you're taking all the risk upfront, and you're not getting any benefit because you're not getting any discount on the valuation or anything like that. So in general, uncapped safes, like, look really hard at those before making an investment decision. In addition, low runway. So runway is basically how much cash does a startup or a business have in the bank versus how much are they burning each month for employee and operational expenses. If companies have less than, say, 6 months of runway, we call it out as a flag. And that's a concern, right? Because they might be raising this round, but if, for example, their crowdfunding round, doesn't go as well as expected, that means they could be running out of cash in as little as, 6 months. So it's definitely something to take a look at in terms of cash position. In addition, think of things like lawsuits. Repurchase rights is another deal term for safes, which means that people can buy it back. And they may buy it back at fair market value, but it puts a little bit of a conflict of interest between the founder, who might want to buy it back or might be forced by their board to buy it back, versus the investors who really want to be in it for the long term. So that's just something that we call out to pay attention to. But other things, right? Large year-over-year revenue drops, high revenue multiples. This means it's your valuation divided by your revenue, and all obviously others, insiders selling shares, excuse me. So sometimes, right, you can think if a founder of a company is, just getting started and they're selling a really large percentage of their own ownership in the current round, you might kind of wonder, like, if you're in this and you really believe in this company, why are you selling so many of your own shares? It's not always a red flag. There can be reasons, right, to take some off the table, but these are things we call out to be able to help investors, make more informed decisions. So you can at least look at these or look into these and say, okay, yes, I understand why they're doing that. There's a good reason for it. Around deal terms, right? So different terms and different security types require different types of diligence. So there's equity deals out there. And so you need to be looking at things like, are these common or preferred shares? Common shares, typically are what the founder's employees will have. Preferred shares might be what a, venture capital traditional angel investor might get. However, you need to look at what's being offered for a couple different reasons. For example, if you have preferred shares, it may come with liquidation preferences. Now, as an investor, that can be a good thing because that kind of protects you and makes sure you get some of your capital back if stuff doesn't go well. But if you're investing in deal and you're investing in common shares, but there was already a whole bunch of preferred shares issued earlier, that can be more of a red flag for you, because what that means is that there's kind of other investors in the capital stack that are going to get their money back before you. So just something to look into and be aware of in terms of where you are in terms of that preference stack. In addition, look at the valuation, right? This is one of the most important things for any equity deal, is just your pre-money or post-money valuation in terms of how much is this team, the founder, selling, and then how much are you getting in return for your investment. And then voting rights are something that you're not typically going to see with investment crowdfunding deals. They'll usually be delegated to the CEO or lead investor, but you can just take a look at that. And if you are writing a larger check, that may be something you want to look into. Then there's safe and convertible notes. So safe, simple agreement for future equity, and convertible notes. These are both convertibles, right, that convert into equity at a future time. So you need to understand what are the conversion triggers. That differs very widely across the different platforms and the different deal terms I've seen. So it's almost, never the same in terms of what certain things may trigger. Also liquidation rights. So in the event of a sale, or, if things don't go as well and need to get wound down, make sure you understand kind of how that works in terms of typically safes and convertible notes. You're not going to be getting much back because that's not equity. It hasn't converted to equity. But again, every deal term differs. So take a look at that. In addition, for safes, similar to valuation for equity, is look at the valuation cap and then the discount rates. So these tend to be how it will convert at that next financing round when the trigger conversions kick in. And then repurchase rights, we've touched on that briefly as a potential red flag. And it's a good question to ask whenever you see a safe or convertible note. Why is this company offering it, right? So traditionally, when these instruments were kind of started for, traditional angel investors and venture capital, it was because they were perhaps a company that was going to do a priced round, a bigger round like a seed or a Series A later on. They weren't quite there yet. And so they just needed a really short-term instrument to kind of hold them over for a few months to give them financing so then they can make it to that bigger round. Sometimes, right, that can make sense, but you need to make sure, is this company offering it because it makes sense and they have a plan like that for what the next funding? Or are they just doing this because, hey, it's, kind of easy and cheap, and you need to be a little bit more cautious in terms of looking at that. Then there's debt and revenue share deals. These are things where you'll have deal terms like interest rates, maturity dates, and perhaps payback multiples if it's a revenue share. So for example, it might be, hey, we'll pay you up to 1.5x your initial investment, and then you're considered paid off. And in addition, sometimes they'll specify things such as seniority and security. So making sure you can, again, understand where you kind of stand in that cap stack in terms of, when you get your money back, how it's paid out and in what order. A couple quick due diligence mistakes. So first one I see a lot of time, and I've often made myself, it's this one size fits all investment. So this is basically taking an approach and thinking that every business is going to follow this exact same cookie cutter mold, when in fact, right, every company is different. You might be looking at a super early pre-revenue company that hasn't even launched a product yet, and you can't compare that to a company that has millions in revenue that's been in the market for years, right? So you need to take that on a case-by-case basis and just adjust kind of the different areas that you're looking at of due diligence based on where the company is. Also, another one that I fall victim to a lot is getting excited about a product because I'm like, oh, this is a fantastic business. They have a great technology. That doesn't necessarily mean it's a good investment though, right? You could have a fantastic business, like killer technology, but if the valuation of that is just set absurdly high, you're not going to get a good return on your investment. It lowers your potential return on investment in the future. So that's where you need to really make sure the deal terms are coming in and being looked at. In addition, right, just thinking to kind of get from point A to point B and B to C, you need different skill sets in different times and different parts of your business. So don't extrapolate kind of past success for what got them to where they're at to mistake that for what they'll need to have to make it to the next step. That's, what got you here won't get you there. And then another one from Seraph Investor that they kind of say that I agree with, again, going back to team, is the issue often comes down to the fact that an A team with a B plan will outperform a B team with an A plan every time. Again, this is more specific to very early stage businesses where the founder and the team is such a key part of it, but remembering that. And then, of course, I mentioned this up front, don't rush the process, right? FOMO, fear of missing out, it's definitely a real thing. A lot of these founders are going to sound super passionate and super fantastic and tell you, oh, you got to invest now, and this is the last chance you're ever going to have to invest at this valuation, right? You need to be measured. You need to be calm. You need to come at it with an objective process as an investor. So what I use for my own framework, and I can kind of map this to what King's Crowd does, but just to make it easy to remember, it's called the 5 T's. These are the 5 areas that I look at. So at the core, at the center, I put the team and the founders, because again, I really believe that's the most important. But then there's the tech, which is, the solution or the service or the offering. There's the TAM, which is my T for market or total addressable market. How big can it get? How big is it growing that they're addressing? Traction. So this could be in users, it could be in revenues, it could be in profits, depending on where the company is in their life cycle. And then the terms, obviously, really important, as we discussed. What's the valuation or the discount or the interest rates? So as I like to say, again, for early stage startups, for me, and everyone will be a little bit different, have a different blend, but it really comes down to the team and the founders, making sure they're amazing. And if they are amazing, great, I can move on. If they aren't amazing, then unless it's like a really great product or a really great market, I'll probably move on to another opportunity. What I like to kind of use as a little analogy, right, for this team is you think of a symphony orchestra. You have some of the absolute world-class best musicians on each of their individual instruments, but without that conductor, without that glue bringing everyone together and harmonizing them, you don't get the beautiful outcome of what a symphony orchestra is. So in a similar way, what I envision the founder being of an early stage startup is like that conductor who's kind of bringing everyone together, who's making sure that vision is aligned, who's making sure that everyone's in lockstep, moving towards the same goals and objectives. So I'm going to be wrapping up. I know it's about a little bit past the half hour here. So just in terms of team, I'll go through real quick, but then the rest, I will share a link where you can get my own checklist that I kind of use. So again, for team, for me, I kind of look at this as like a pass fail. Team has to be absolutely amazing. I just want to see passion in the founder. I want to know that they're in this for the right reasons. I want to hear why they're building this. Was it a pain point that they had themselves? Do they believe in this mission? All those things are really important. I'll skip through some of these other things, but I can share these afterwards. And then obviously I will just say, correlation is not causation. So just because there's a lot of studies out there that say that founders with past successful exits tend to be more successful moving forward than founders who didn't, that doesn't work for, the Steve Jobs, the Bill Gates, some of these different people out there, right, of entrepreneurs. So, take everything with a grain of salt, but, trust your gut in a lot of ways. A lot of looking at some of these early stage companies, you'll be able to look at data, you'll be able to look at financials, but there's something to the human initial gut reaction that is going to train over time as you look at more and more of these opportunities, and you'll be able to get a good sense. And so just for King's Crowd, how we kind of map those 5 T's, we break it down into price, market, team, differentiators, and performance. But however you think of this, right, you can come up with your own frameworks as well. Just thinking about coming at this at kind of this more objective checklist approach that'll help you be more measured, more level-headed when you're looking at some of these founders and some of these opportunities. So this is my last slide here, but feel free to get a free copy of the checklist at the link here. And basically it goes through some of my other questions in the other 5 T areas that I talked about. I kind of just talk about, certain things for me, for my own deal funnel, how I look at this, some different things I look at different stages and different red flags. So I'll pause there, but if there's any questions, thank you, everyone.
Wonderful. Thank you so much, Brian. Do you guys love the way Brian kind of makes this plain and you understand it? It's not intimidating. I know I do. So what you guys may not know is Brian used to have a company called Crowdwise. When we started, it is what Cherie and we kind of went through his course of sessions to learn about crowdfunding. And I just love his delivery. And so you did not disappoint, Brian. Thank you so very much again for
Thank
sharing.
you for the kind words. I really appreciate it.
What questions do you guys have? Did this all make sense? Talk to me. Are there any questions you guys have? We're watching pitches every week, right? We've done this for the last 3.5 years now that we've actually had pitches. What are the questions that you would like to ask Brian as it relates to what we go through? We have a unique situation where we get to ask the founder some questions live, right? So we get to kind of peel back some layers that just looking at research information doesn't give.
And that's I just want to say that's a huge benefit too, right? Yeah. Because a lot of the times on the campaign pages and videos, you're seeing, for lack of a better term, but you're seeing like a really polished version, right, of something that they rehearsed or scripted. And so when you get that one-on-one or group time together to ask questions, take advantage of that, because that's super helpful to just be able to understand that founder and that team and get to know them better and how they work.
Yeah, and how much they really have thought through the business model, right? When we're asking them questions, like I remember, I won't say a name, obviously, for out of respect, but we had a founder one time, and every time the community member the community members were throwing out ideas on what they should do, they were like, oh, I didn't think of that. We should do that. Oh, I didn't think of that. And I think he said, I didn't think of that like 50 times. And I thought, I need you to think a little more, because we shouldn't be developing your business model in real time for you. But then we've had, right. And so you wouldn't have known that from the polished campaign video and from all of the information that was on the site. And so the pitches are absolutely beneficial to helping us get to that gut, right, that we talk about a little bit. I see a question. So Barbara said, how do you measure passion?
That is an excellent question. I won't say that I have a quantifiable scale of, passion, but I think it's something, especially again, if you're talking to these founders, you can sense when you're on the call with them. One of the tests, I kind of use like 2 tests, I guess, for myself when I think about maybe that passion question in terms of the founder. One is, again, really getting to the core of why is this person working on this problem or this business? And if it seems like, hey, they're kind of starting this because they, want to make money or get rich, maybe not the right idea. But if they're doing this because, they had a brother or a family member who had this issue or this illness, and now they want to change the world to, cure something for them. And like, that person is in this 1000%. And when it comes to the challenges that are going to pop up inevitably with startups, that they're going to try and find ways, to break through those roadblocks and those challenges. So that's kind of one way I think of it. The other thing I kind of ask myself when I'm meeting a founder, or just like listening to them talk, is like, is this someone I would want to work for myself? Right. So you can kind of put yourself in that position of, okay, yeah, this is someone who is, I think they have the right attitude. They're like really helpful. They want to grow their team. That's important because they're going to attract the right team members, and, they kind of have the right mix of skills and talent and purpose for being in this. Versus if it's someone who I'm like, I don't know if I could really, picture myself working for them, or they seem like kind of, just not in it for the right reasons, then it might be a little bit different approach there. So I'm curious if anyone else has any other thoughts, in terms of measuring passion. So.
Yeah, for me, do they have skin in the game, right?
Mhm.
Like, how much of their own money and over what time frame have they funded this thing? Because that's a level of passion, right? If you've
100%.
funded this for the first 5 years on your own and now you're asking for help, I can get behind that because you're in this, right? And you've got kind of this stick to itness, right? So that's a big one for me. Talisha, can you think of anything else?
I think along the lines of, I do that. Would I work for this person? Because I feel as an investor, we are in business together. Like, maybe I don't work with you directly, but I'm working with you. And so do I see you successfully, managing your team? Or do you seem like that person who is, an overlord and just driving people crazy? Because I'm like, maybe you're not the person, maybe you have the drive, but you're driving your team away. So I need to see the cohesiveness and your foundation for this work, and for you to go the long haul and not browbeat your team up to get to that success point. So there's a little bit of that I kind of think of, not just like, oh, would I work for you, but in a sense, how do we collaborate to get you to the final line?
Such a good point.
That's a good one. Jackie said that personally, she doesn't invest in founders that don't answer her questions. Jackie, that's a good one. You have to be careful though, right? Because sometimes, especially for the pitches that we do, sometimes the SEC doesn't allow them to answer certain questions also. And so if you guys notice, when that happens, sometimes I'll jump in and answer the question because I want to save them from themselves, right? We don't want them to get in trouble with the SEC, but I also don't want them to come across to you like they're being evasive. And so sometimes I'll jump in and kind of answer the question on their behalf because I know the SEC doesn't allow them to answer it.
And to piggyback on that, it's on the offering page, they theoretically should be able to answer any question. So if you're asking a question on the offering page and they're avoiding certain questions or certain things, that may be more of a flag versus absolutely. If they're presenting, there's certain things they can and can't say if they're like on a Zoom or at a conference or something like that. So very good picking up.
Which is why we drive you to that questions and answer section in their campaign page, because that's where the conversations can really happen.
Yeah. And like for me, again, this is just my personal opinion, but sometimes you'll see like blanket responses to every like investor question put in there by like a team member that says like, reach out to us at investors at this company. And to me, they're either trying to hide something because they're not posting it publicly, or, they aren't using the regulations as they're supposed to be, right? This is supposed to be more of a community driven thing where all of the information is made available to all of the investors at the same point in time. That's why they sometimes can't say something on a call that they can say on the campaign page, but anything that's on there, is available to everyone. So for me, absolutely, I'm there with you. I look for honesty, transparency. Do I feel like they're just, even the good and the bad? I want to hear some of the bad news too. Like, don't feel like you need to hide that from investors.
Yeah,
that question and answer page is also very indicative. If you see those canned responses and they're all on the same day, like they let the questions just load up, it seems like somebody was just tasked with, because they're not a person who is aligned. It's just some person who says, okay, just go ahead and answer these questions. Here's your rote answer to that question. And you can see that. And there's some that are I've seen some of the questions and answers, they're getting back to them like they're having real-time conversations. I see the founder actually having going back and forth. And that gives me that feeling that this person is setting some time away from their business because they're really trying to run the business. They're setting that time to really engage with these people to be their investors. So that gives me more kind of, I look at them like you're trying your best to really engage these people to be informed about your campaign.
Yeah. Yeah. For me also, the team component of the T's, right? That team one is huge. I don't know that I realized it as much until we start, we're on like 140 pitches, right, Brian?
Wow,
So yeah. So
amazing.
I don't know that I realized it until you start seeing more and more of that, because, I grew up where, you kind of, entrepreneurs hustle, and there's respect in the hustle, right? Like they go all night and they go hard and there's a hustle, but that only lasts so long when you're doing that by yourself, right? And we're talking about trying to when you talk about having minimal success, that's okay. But when you talk about taking on investors and having enough success that we all benefit from it, there's a different set of lenses that I'm looking at this through, right? And so now the team matters, because as an entrepreneur, I know that it is impossible to do all of this by yourself, right? And it's possible to do it with 2 or 3 people helping you. You need a team. And so when the team is not developed, that's huge for me. It really, really is. And even when I think the product or the service is amazing, I actually sometimes think it's going to be successful, but a lot longer down the line once they get a developed team. And I may not invest even if I really believe in the project, right? And even if everything else about the project looks good, we've had some founders that they've made already millions of dollars in revenue. They're still going it alone. Like, at what point do you take some of that revenue and hire people to help you? So like, I'm thinking about all of that when I'm going through my due diligence process as well.
Absolutely.
Definitely a red flag, I would say. That the solopreneur is not a business make.
Yeah, agreed.
Yeah, you can build, a great business for the entrepreneur in a lot of cases like that. But yeah, as an investor, you need to be asking the question of, okay, how do not trying to be selfish, but like, how do I get a return from this, right? I'm investing because I believe there's going to be potential here for me to get a return. So making sure it's not just going to be a business that the founder's just happy, kind of running out of their garage by themselves for the next 20 years, and you're never going to see your money back.
Yeah, and those businesses are okay. They just should
Absolutely. Yeah.
They shouldn't take on
difference. That's
Yes.
taking on money. And I think we'll see this as the AI progresses. We're talking of having these conversations of a solopreneur with an AI team and how they will compete in this market. And that still kind of goes to, just because it's you who is managing this, even if it's all automated, what happens when one thing goes down? I always think about the tech support aspect. If you try to run the business and your whole CRM goes down, now you have to take away. So we need to be cautious in thinking that a single person, while we can run a business, is that the most effective way to do it? And when we're taking on investors, how do we really become responsible to those individuals plus maintain that business?
Yeah. Yeah. Ms. Patrice says burn rate is a question I think of asking investors. She says, is that how you ask the question? What is your burn rate? Or is there a better way to get to that answer?
Yeah, so typically most people of the founders and entrepreneurs will well understand and should know what their most recent burn rate is. So that's one of the things we always, if it's not, this is actually a really good point. We'll spend a minute on this. So when a company has to file their financials, they have to file the prior fiscal year, their most recent fiscal year, and the one before that. However, let's say that we're launching our campaign in December of, this year of 2024. Our most recent fiscal year could be December of 2023. So we may be filing financials that are a year out of date now. So it is absolutely acceptable for investors to say, hey, your last financials were from 2023. Can you let us know what is your most recent burn? Other ways of getting that is like, how much cash do you have right now? And with those two things, you can then calculate the runway, which is like, okay, if they have $1 million of cash and we know they're burning $100,000 a month, you can do 1 million divided by 100,000 and they have 10 months of runway. So it's basically, they could keep operating like that if nothing else changes and be able to go for 10 months before they run out of money. So that's one of the big flags that we look at, but you can absolutely ask that. I'll share another tidbit, interesting thing in info. Sometimes founders will say they're not allowed to give that number on the offering page. And maybe there's some legal reasons out there that we're not aware of, but they should be able to give that number. So if they're avoiding that question, it's maybe because they don't want to disclose what that is, or it may look bad for them.
Perfect. Very, very good. I'll say this in closing. Talisha and I had a conversation. I think we were talking yesterday. And after I hung up with her, I felt like we memorialized some deals that had gone bad in 2023. Like we had this unofficial memorial for some of our deals that just didn't pan out, right? And it's going to happen, right? When we finished talking, I thought, it's going to happen. They can't all succeed, right? And as sad as that is, and as much as we believed in the founder and we thought they were the ones that were going to take us to the what we call success, right? That ROI, all deals won't make it for a lot of different reasons. And I love that Brian showed us that slide that kind of talked about what some of those reasons are, right? And as you saw, it's not always about money. Sometimes it's about other things. I tend to agree though, Brian, that it is ultimately because the founder gave up. They just decided for whatever reason, they did not want to go it anymore. Maybe they didn't want to go it alone, right? Because they couldn't find the right team. Maybe they just kept being tired of beg, borrow, and stealing from, robbing people to pay the fall. Like whatever the case is, ultimately that is what I believe causes the closing or the ending of the business. So for all of you entrepreneurs out there, push through. Try to make it another day, right? I think I posted something today, not even knowing Brian was going to say that, right? Is maybe we're not being patient enough. Maybe our expectations of success isn't lining up accurately, right? So make sure you're being patient. Make sure if you're being patient, make sure you've got a solid business plan and business model, right? But also you got to be flexible. You got to be agile because the industries, every industry is changing around us, right? Talisha just brought up AI. And so you've got to think about that as industries change and technology changes and supply chain is all the things that affect your business. As those things change, you can't stay the same and succeed. You have to be able to pivot, sharpen your business model, but don't give up. Don't give up, right? Try everything and then ask for help, which is something I'm terrible at as an entrepreneur, right? Ask for help, get help, put those people around you that can help you get to the next level. And so, I just wanted to say that as we memorialize some of our deals, some of you I know are in some of those deals that we talked about. And so memorialize them and let them go. There's nothing we could have done differently, right? We did our due diligence, right? And we still came up with this was a good bet, but it's investing. They're not all going to make it. But for the ones that do, right? And I love the other slide that Brian showed with once you do your due diligence, the odds of success increase. And so I say that every week to you guys, do your due diligence, right? Don't invest in these founders because they make us laugh or because we think we like them, right? We don't know them, right? We just met them on Tuesday. And so I may have talked to them more than you did, but you just met them on Tuesday. So you've got to do your due diligence. And so, Brian, thank you so very much for showing us how to do that and for providing us with a free resource and giving us that. And again, I love CrowdWise. I love King's Crowd. So everywhere you go, I love Brian.
Thank you. Likewise, I love what you're doing with the 10K project. So thank you for having me and really appreciate everyone here.
Yes. Any final questions for Brian? Talisha, anything for you?
I think Miss Patrice has one. She says, is there an official way to close a deal or do they just quote unquote ghost?
So it depends. Sometimes the companies will be pretty good and they will officially kind of put in the paperwork with their state Department of State to dissolve, and they'll email their customers or their investors and they'll say, hey, we're going out of business. Here's our dissolution paperwork. A lot of times companies that are shutting down don't have money. And so for one reason or another, you can't get a reaction, you can't get an email. Hopefully they'll at least provide an update and let you know that they're shutting down. And a lot of the companies, we found will at least let their investors know, hey, we're winding down. But it's going to vary in terms of how good they are in terms of like doing all the paperwork to actually dissolve the business. I don't know if you've seen any differences on your end, but.
Yeah, I think there's that. And then sometimes there are fees associated with dissolving a company
Exactly.
officially. And if you don't have money, you don't have the $699 it costs to do the fee. But if you don't file, eventually they will dissolve you automatically, right? But that may take 6 months of not paying your fees or your taxes or whatever. And so sometimes that happens as well. I think founders do need to do a better job of that, right? Almost, for us, we need closure as investors, right? And I don't think they realize that, but I want to believe that there is a shame and a guilt that's associated with that, right? And that they may not be brave enough to come yet and say, I'm sorry that I failed, right? And so I think we should probably forgive them for not being able to have that. I've had some founders come and have very honest conversations about closures, very, very communicative around it. Even, giving us, like one right now, she's keeping us up to speed. She's in the process of trying to sell it. She's keeping us up to speed. She's giving us updates, right? And she's catching fire from every investor every time she comes to talk to us, but she keeps coming with the updates. And so I respect that. Even though I know it's so hard for her to do, because not everybody appreciates the updates, right? It's the reopening of the wound over and over again every time she gives an update. But there's something to be said about that closure. If she had another business, I would invest in her because she's the kind of founder that has gained my respect, right? Even though this business didn't make it, she's handling this all the way to the end in such a respectful way. And I love that.
Such a good point. It's, a lot of these people are going to go on and start another business, right? So seeing their character of how they deal with the tough outcomes can really tell you a lot. And, look out for that person again when they start their next company.
Yeah. Well, very good. Brian, thank you so much.
Thank you. Thanks for having me.
No, yes, this was great. Guys, no pitch tomorrow. As you can see, I'm traveling again this week. No pitch, but we'll come back on the 18th strong. I know you guys are like, what the hell? No pitch in 2 weeks in a row? I know, I've been traveling. I'm sorry.
This is what happens. Day jobs take precedence.
This is what happens when you're a part-time entrepreneur. Don't invest in me, right? I'm not ready to take on investors. So thank you so much, guys. I appreciate you all. Brian, thank you so much. Brian and I are getting ready to work together. We're going to be judges for
I saw that. That's great.
So I'm so excited to work with you in a few weeks.
Likewise.
Awesome. All right, everyone. Have a good night.
Thank you again, Brian.
Good night. Thanks, everyone.
Bye.